Federal Reserve is expected to raise interest rates by another 0.75 percentage point today.
Yeah, regulators are trying to bring down the worst inflation that we've seen in 40 years. And this recent string of hikes are the most aggressive in decades. So far, it's done little to bring the prices down or bring them under control. And questions about just how far the Fed needs to go remain. So Megan Greene is joining us now. She's a senior fellow at Brown University and the global chief economist at Kroll Institute, which is an independent provider of risk and financial advisory solutions. Thank you so much for joining us, Megan. So let's talk about this. Can you give us a breakdown of why the Fed could issue another massive rate hike? And I know for me personally, because I don't know much about this, my gut feeling, based on no knowledge at all, is why don't you wait a little and see what the impact of the current rate hikes are? But they seem to think that they have to keep this, what feels like a breakneck schedule.
Yeah, so you're right. Actually, interest rate moves have a lag before they actually hit the economy. So there is a question about all of the aggressive tightening that has already happened. But what is keeping the Fed with its, foot on the gas is that actually, unfortunately, inflation doesn't seem to be coming down. We economists expected core inflation, stripping out volatile energy and food costs, to have peaked already. And what we've seen is it's actually just accelerated in August and September. We won't have the next inflation data point for another few weeks, but the Fed feels like they have to continue tightening in order to slow down the economy and also in order to keep inflation expectations grounded so that everybody expects the Fed will bring inflation down to 2%. The central bank's worst nightmare is if those inflation expectations get de-anchored and everyone expects prices to rise. So they go out and buy now so that they can beat those price rises, and that pushes prices up. And then you get a kind of spiral. So that's what the Fed is trying to lean against.
These hikes directly impact the cost of borrowing, as you know. So what could this do to the housing market?
Yeah, so this should slow the housing market down even more. And that's not a bug. That's the point of rate hikes. It should slow down the housing market, but it should also, as you point out, make all borrowing more expensive. So, credit card borrowing will get more expensive. Car loans will get more expensive. That's the whole point, though. The Fed is trying to slow down demand so that it comes back into equilibrium with supply and so that prices will stop rising so much.
So I learned something the other day that not only are we seeing inflation with goods, but we're also seeing inflation with services. Like, your hairdresser, your mechanic, they're charging more. And so if they're charging more, that means there's more money going around. People are willing to spend that money. And so that also has a major impact on inflation. And so I want to ask you, why isn't this working so far? Why are we willing to spend these higher prices, pay more to get our hair done or our car fixed or to buy eggs at the grocery store?
So some of it is down to the pandemic. We all got locked down and a lot of people got stimulus checks. And so when we reopen, there's just been a lot of revenge spending, a lot of revenge traveling, a lot of revenge services now that we can get them. And so the question is, how long will people be willing to do this? One concern for the central bank is that actually people are demanding higher wages too, so they can actually afford more. And if you get higher wages, then companies feel like they're going to pass off that higher cost in the form of higher prices. And so you get a wage price spiral. That's what the Fed is trying to lean against as well. And so, inflation has been stubbornly high for way too long. And the Fed feels like they have to keep tightening in order to bring it down.
So when will it end? What signs will Fed watchers be paying close attention for?
Yeah, because we don't want a recession. I don't know what's worse, high inflation or a recession. They both sound terrible.
Yeah, they're not good options. I think, unfortunately, we are going to have a recession. And the idea is that having a recession now, because the Fed tightened proactively, is less painful than the deeper recession we would have later if the Fed went ahead and waited. So today, we know that the Fed will hike by 75 basis points. That's pretty much baked in. But we'll be looking to see what the Fed is signaling for its next meeting in December. I think it's very likely that the Fed will slow down the pace of rate hikes after this one. So I think in December, they'll hike by 50 basis points instead of 75 basis points. And then next year, they'll hike in even smaller increments, 25 basis points. So the signaling around what they'll do going into December and also going into next year will be really important.
All right. Megan Greene, thank you very much as always. Appreciate it.